I am about to show you the most important investing frameworks that took me from not being able to make any money investing to now, thankfully, beating the market year after year. This will be your new investing playbook to actually make profit. And if you learn and understand what I'm about to cover in this video, then it might very well be one of the most impactful videos you've watched on investing. We are going to go over 7 principles that change the way that I think about investing, plus a bonus when it comes to investing with options. That took me a while to figure out, so for those of you who are here for options, stick around. I think it'll be worth it. Now, at the end of this video, I am going to take you through my personal investing journey that got me to this point so that you can understand what I needed to change in order to start investing the right way. And then you can go ahead and simply copy and paste this framework to start making profit yourself. Hello everybody, my name is Alex Pandrea and welcome back to my channel. Now I want to jump straight into this, and to do this, to set up this whole thing, we need to understand what is holding us back from making money investing. Well, here's what I think, what the main problem with investing is. There is too much information out there. There are too many options of things that you can invest in and countless ways to invest your money. You have endless content out there telling you to invest in low-cost index funds and blah, blah, blah. And you're like, okay. And on the other hand, you have random people telling you that you can 10x your money with these hot new stocks. And you're like, okay. And you are constantly stuck in this limbo of not making money or even losing money. Now, let me tell you a secret. That was me. For a long time, I was confused. I was jumping around from investment to investment as if I was playing some game of whack-a-mole, always a step behind. I lost years of potential gains by not understanding that I was stuck in this limbo myself. So what exactly did I do to break out of it? Well, the first step is to answer the following question, and it's a simple one. What type of investor are you? Now, if you asked me this many years ago, I couldn't tell you. But being able to answer this question will dictate everything else, from the decisions that you make to how much profit you will generate. So let's take a look at some of the common ways of investing. Now, what I want you to do for right now is just sit back and relax and just listen to what each of these strategies entail. Now, we are not making any decision yet or putting ourselves into any particular category, but the answer to this question will slowly become more obvious as we work our way through all of the ideas in this video, and hopefully by the end of this video, you'll have a better understanding of what path you should be on. So here is a list of the most common ways of investing. Now, of course, there are other things that we can add to the list, but here are the most common, and I think the ones that we should start understanding first and foremost. So first on the list, I want to talk about value investing. Now, what is value investing? Now, value investing is a strategy that has been popularized by Warren Buffett, but it goes back to the teachings of Benjamin Graham. And the concept of this strategy is that you want to find companies or stocks that are trading below their intrinsic value. Basically, you want to invest in companies at a discount to their fair value. Now, another way of saying this is that you want to buy stocks when they are on sale from what they're actually worth. Now, this goes without saying that you need to understand how to research companies in order to be able to value them properly, or at least as best you can, and then buy them when they are trading below that value. Now, obviously, the biggest factor here in value investing is you're going to need to be able to value that company, value that stock. So understanding how to read the balance sheet and the income statement and things like that are going to help you in trying to value that company. Now, if you're thinking to yourself, well, that seems like a lot of work. Well, yes, it should be a lot of work. Investing shouldn't be easy. It shouldn't be easy to make money in the stock market. But if you can learn the strategies that go into value investing, I think it could be worth it. Now, moving on to growth investing. Now, growth investing is investing in companies that have the potential to grow and grow a lot. Now, I want you to think of the tech companies that have boomed over the last 20 years, right? Or possibly the AI revolution coming up now. Or going back quite a bit, we can think about railroad companies and the boom that they had in the early 1900s. Either way, growth investing is about understanding where the world is heading and what companies will succeed in pushing the world to the direction that it's going. So in our case today, it's all about technology, right? So technology companies would be considered growth companies because they have that power to exponentially grow as the technology grows and as the world evolves. Now, pros and cons of this is obviously you can make quite a bit of money as so many people pour into these growth companies, into these tech companies. They can 2x, 5x, 10x. But there is some risk that you can create a bubble, right? Take a look again at the dot-com bubble. A lot of people made a lot of money during that time, and also a lot of people lost it all. So the idea here is to find the companies that are going to be the winners in that space, and hopefully you're not caught up in some bubble where everything comes crashing down and you lose everything. Now, if those first two strategies maybe don't do it for you, then you can just go to passive index investing. And this is probably the most common way of investing that people that don't know much about investing would stick to. And it makes sense, right? You don't have to know so much about this. Now, for value investing, there's quite a bit that you have to learn, right? Before you get into value investing. Growth investing, possibly you can take your chances, but the odds of you choosing the winners out of the tech boom, the AI boom, whatever boom you want to talk about can potentially be quite small. So you might think that I might just stick to passive index investing. And passive index investing is obviously that you put your money to work to compound. And for this to work, you need time. And we're going to talk about that more in the compounding section coming up next. But just know that passive index investing doesn't take much knowledge to get started with or continue on with. Next up, dividend investing. Now, how does dividend investing differ from the previous strategies that we spoke about? Well, in value, growth, and passive index investing, the concept here is to have your money, your portfolio, whether they be in growth stocks, value stocks, or in passive index mutual funds, for example, to grow over time in stock appreciation or portfolio appreciation. Now, with dividend investing, the idea here is to extract cash from your investing and your portfolio in order to either have income or to reinvest further those dividend payments. Now, obviously, there's pros and cons to this as well. And one of the pros here is obviously you're extracting cash, right? So you can get a cash payment from just holding that stock that you can use for your life expenses. The cons, some might say, is that dividend investing does not have the same appreciation that you would have if you go with one of these other types of strategies, because that dividend payment is taken out from that stock appreciation, right? So when a stock goes up and up and up, and when they pay a dividend, that stock falls to match the dividend payment, right? So it's almost like you have a choice, right? Do you want to keep your money in the stock at a certain price, or do you want to sell a little bit of that stock, get that cash, and use that cash for whatever you want to use it for? Now, there's a very important distinction here, right? Either you leave your money compounding or you extract cash. Now, of course, you can extract that cash and reinvest it, but where do you reinvest that dividend? Do you reinvest it in the same company? Do you look for other opportunities? So there's a lot that goes into play with dividend investing. Now, the last thing that I have on the list is day trading or swing trading. Now, I will keep this brief. In my personal opinion, my experience, I do not believe that this is an investing strategy that one should focus on. I put it on the list only as a word of caution. I think the evidence would support this. I do not believe that day traders can consistently beat the market, or at least do better than some of these other types of ways of investing. Now, swing trading is a little bit different. Maybe you have a trade put on for a month time, 3 months time, 6 months time. If there's a bull run going and you invest your money for a shorter period of time, hoping to catch that piece of the bull run, then potentially you can make some profit. But the key word here is consistency. Can you consistently make a profit doing this? Can you consistently beat the market? Can you consistently make more money than dividend investing or growth investing or even passive index investing? I don't know if you can. Short-term trading and short-term thinking usually doesn't lead to too good of an outcome. And even when investing with options, a lot of people would think of trading options as day trading options or getting that quick profit. And I'm here to tell you, at least for me personally, and the philosophy that I want to bring to you guys here on this channel, we want to be able to take things like options and use them in conjunction with the overall investing that we should be doing to try to beat the market in a smart way. All right, so now you may look at this and already be in one of these categories, perhaps a few. Maybe you have a portion of your money in index funds and some in individual stocks paying you a dividend. Maybe you tried to roll the dice a little bit on day trading, and again, we talked about why maybe you shouldn't do that. Well, so here is the bad news if we take a step back. It is my belief, and I think again, the research might support this, that you need to be able to pick one investing philosophy and stick to it long enough to let that strategy play out and make you a profit. The more you mix these strategies together, the less money you will ultimately make. Now, there is a very simple explanation to this, and that is consistency, like we talked about, but also diversification. Now, in a stock portfolio, you can diversify quite a bit, right? You can own 20 stocks, 30 stocks, 50 stocks, and usually you won't make the same return you would if you would have held a more concentrated portfolio of the best 10 stocks. You are diversifying too much. Well, the same idea can be applied across these different strategies. If you diversify your strategies, then you don't give one particular strategy time to extract value from it. So, for example, if you only have like 20% of your portfolio in dividend stocks and the rest in an index fund, well, then you are collecting, let's say, 5% in dividends off of only 20% of your money. While on the other hand, compounding your money through index funds, but you're only compounding 80% of your money instead of the entire amount. So in this case, you are diluting your returns, right? Another problem comes from your mental framework that you would need to invest in different strategies. All these strategies consist of a different way of thinking, and it all comes down to your individual goals as an investor, right? So first things first, pick one strategy and stick to it for a period of time and be consistent, okay? Passive index investing doesn't work unless you're compounding your money, doubling it every 7 years and then doubling it again 7 years later and again 7 years after that. Value investing doesn't work unless you are able to do deep research that is needed to analyze stocks. But here's the asterisk to that. You can certainly switch between investing strategies at different points throughout your investing journey. So an easy example of this would be to first stick with high growth stocks, right? That you can make a great return in maybe let's say your 20s, right? And if you catch a technology boom or maybe this AI revolution and you invest in companies and you make a great return investing in the best companies of that sector, then you'll have a good amount of money to then switch to compound investing, right? Say the boom is over, you made your money, stick it into a passive index fund and compound your money in your 30s and in your 40s and in your 50s, doubling your money every 7 years. Then later on, you might think of capital preservation and stick to dividend investing, right? And live off those dividends that are paying you 4, 5, 6%, because then your goal as an investor has changed. So final point on this, think about what type of investor you want to be at what stage of life you are, what your goals are. But at the end of the day, I just want you to pick one, stick with it, extract as much value of that as possible, and then move on from there. Now, for me, it seems pretty straightforward that in order to be a successful investor, you can't just rely on investing by itself. So basically, what I do is I take income from my businesses and I put that into investing because that makes compounding that much quicker. Now, if you start with a small sum and only try to invest that amount, then you would have a hard time compounding it, especially, us as sort of non-professional investors or traders will make smaller returns, right? Maybe we get lucky a few times, but we'll make smaller returns. So that's why it's very important. This is the strategy that I took on, is to make money off of my business and then infusing that into my investing account. Majority of time it's just going into a buy and hold stock portfolio, but nonetheless, I'm concentrating on the income side of the equation before the investing side. That's very important. So what am I getting at here? Well, I started a free business newsletter where I give you a whole bunch of business ideas and ways to make money and investing tips, all of that good stuff. So whether you want to start your own business or you have an existing one and want to grow it, I think you'll find some value in this newsletter. So every week I send you 3 interesting creative business ideas that anybody can steal. So I would really appreciate it if you signed up. It's free. It's always going to be free. And we have a lot of interesting things coming with that brand. So first link in the description for the newsletter. Thanks so much, and let's get back to the video. Now let's talk about compounding, because this is something that I think many people don't fully understand, and trust me, I didn't either, and well, probably lost a lot of time and profit because I didn't fully grasp the concept of what compounding really means. So let's break down the basics of compounding. So if you put your money into a low-cost mutual fund that tracks the S&P 500, your money will over the long term double every 7 years. This is because you will be getting a rate of return of about 10%, give or take. Now, obviously, some years will be lower, some years will be higher, but over the long run, it evens out to about 10% a year. So we can use this as a benchmark. Now, here is where people stop in their thinking of compound interest, especially young people. So let's say you invested $5,000 into the market and you want to know how much money you would have at retirement at, let's say, 60 years old. Well, a 10% return will give you about $200,000, $226,000, and that's a 10% return over that period of time. Now, you might look at that and be like, oh, that's pretty good. All I need to do is save $5,000, which I think anyone can do, and you'll make a few $100,000 from not doing anything. But here's what people don't calculate: your potential income over your life and being able to consistently add to this investment over time. Now, let's create a second scenario here. Let's say you start making money in your 20s, you get a job, and you're making a few $1,000s. Well, if you are serious about saving and investing, you might very well be able to take, let's say, $500 per month and invest that. So let's create the scenario. You start with $5,000, the same you started over here. But now you're adding $500 a month from your income. Again, you're working, you have a business, whatever the case may be, you're taking $500, you're saving it, and you're investing it. And at the end of this period, at 6 years old, you'll have about $3 million, okay, with the same rate of return. All right, you're putting your money to work in the same place, but you're just adding to it. So instead of 200 something thousand dollars, you'll have over 10 times that amount. Now, again, some people might stop there in their thinking, but here's where it gets a little bit more interesting. Many people over the course of their lives will actually increase their income. So before, you might only be able to save $500 per month and invest that, whereas now, making more money, having a better job, starting a business and growing that business, you can now invest more, all right? And this is where future thinking comes in. You want to be able to extract your investing into the future. So as where you might do a calculation now based off your current situation, I want you to think further and expand that thinking. So now let's take a look at the example of where your income increases. So instead of $500 a month, we're going to be taking a look at a few $1,000s, $2,000. And I don't think this is unreasonable for somebody to strive for, especially if they're owning a business and they can extract a few $1,000s left over from their profit to investing into a compound machine, okay? So start again with $5,000. We're adding $2,000 every month to that. And this doesn't have to be right away, right? You can start small and grow that from there. And it doesn't have to stop at $2,000. It can increase from there to $5,000 if you're making quite a bit of money, to $10,000 if you have a business and you're running a good business. It is not uncommon to have a few $1,000s left over that you can then invest, right? So with just the $2,000, compounding at the same rate of return, you will end up at 6 years old with over $11 million. Now, I want you to take a look at this. When we calculate backwards from what we ended up with to where we started, you can actually get a much higher return on your overall profit than the 10% that the market offered, right? So take a look over here. If you put $500 a month adding to this, you're going to end up with about a 17% return rather than just a 10% return if you did nothing. Now, with this example of $2,000 a month ending with $11 million, you are creating essentially a rate of return of over 20%, all right? So double the amount that you would get if you just didn't do anything and just let the compound machine do its thing. Yes, you're making a 10% return here, which is about what the market offers. You're making a 17% return here the more money you add. And the more money you add, you actually are increasing this rate of return when everything is said and done. When looking backwards at it, you're ending up with $11 million. You're like, okay, well, I started with this, I added this, I'd actually compounded my money, and I grew it at a rate of return of 20 something percent. Now, this is obviously better than just putting your money in and letting it do its thing and just relying on that 10% return, right? We are using a shortcut to expand these returns. So I think this is very important. You need to be able to understand the true power of compounding in relations to you and the span of your income potential to make a more accurate calculation of what your returns will be. And well, if you can do this, you might think twice about trying to pick stocks and beat the market that way, because that comes with certain risk, right? Which we will cover later on in this video. Now, here's the point of this, and taking a step back, I want you to see the bigger picture here. Now, 10% return means about a double every 7 years, all right? And this is what the market will provide. If you do not think that you can double your money in 7 years or less using another strategy, and you don't have money to invest, right? So you're not adding to this investment, well, then just stick to passive index investing. Now, taking this a step further, if you do have money to invest, let's say you have $2,000 that you know you're going to add to this and you can stick to this over the course of your life, you're making good income, you have a business. I know that I can invest $2,000 in this fund, start with 5,000, add 2,000, you're going to end up with 11 million, which means about a 20% return. This 20% return means that you have to double your money every 3.5 years using another investing strategy in order to get the same return, right? So if you're somebody that can add $2,000 to this fund every month and you don't think that you can double your money every 3.5 years, to get the same return, then again, you might as well just stick to this passive compound index fund investing because that's the return you are going to get. So being able to calculate this out into the future using your income as leverage, adding to your investing and getting this final return, you have to be able to make a choice, knowing your final return, or can I do better using some other investing strategy? Now, I hope this gives you a clearer picture of compounding, okay? So now let's move on. All right, now let's dive into investing in individual stocks, all right? There is one concept that I want you to be familiar with, and it is very counterintuitive, but it is important to understand. See, many people might invest in a bunch of stocks, and when the stocks go up within their portfolio, they would sell out of that company, take the profit, and then put it into the other companies that might not be doing so well to rebalance the portfolio. Well, by doing this, you are capping your potential returns. They say that you are cutting the flowers to water the weeds. Now, in order to properly extract value out of your portfolio, you need to be able to do the opposite. All right, you need to be able to cut the losers and add to your winners. Now, here are two questions that can be the death of profit when investing. First question is, how much lower can it go? As in, when a stock drops 50%, well, how much lower can it go? It's already down 50%. And this is obviously a very bad framework to have because in reality, well, it can go a lot lower, right? It can go down another 50%. It could go down another 90%. Now let's take a look over here. This stock is going down and down and down and down, and it reaches a point where it lost 50% of its value. Now you might look at this chart and you might say, well, how much lower can it go? And well, look, it keeps going and it keeps going. And not, this is just not an example that I just came up with. I mean, you can find this all over the stock market of stocks continuing to go down. So if it hits 50%, no reason why it can't go down another 50%, right? If it hits 50%, there's no reason it can't keep going down until it hits 70% loss, 90% loss. I mean, you see this play out over and over again with bad companies. So how much lower can it go? A very bad question to ask because as history shows, it can go much lower. Now, here is something interesting, and it took me a while to understand this. If a stock drops 50%, it needs to recover 100%, right, to get back to where it started. If a stock drops 70%, then it would need to go up 233% to recover. And if a stock drops 90%, well, then it would need to go up 900% just to break even. The deeper the loss, the harder it will be for it to recover. Not impossible, but less likely. And you are losing opportunity costs while waiting for that recovery. So this is why it's important to cut your losers very quickly. Now, on the flip side, I also hear this question asked a lot. And trust me, I've asked this question myself quite a bit. And that is, how much higher can it go? Now, this again is a mistake because the answer to that question is, well, a lot higher. If a stock is meant to have a 10x return, and you sell it when you make 30%, well, then you just lost a lot of potential gains. Ideally, if you pick the right stock, you never want to sell it. because the right stocks can go up for decades. Now, taking a look at this stock, let's say this stock has in its future meant to do a 300% return from where you bought it. Now, in order to extract this whole value, you need to be able to keep your winners without selling too early. So this stock goes up and up and up, and you've just doubled your money. Let's say it's at this point and it made a 100% return. Well, how much higher can it go? I've already doubled my money. Well, the answer to that is it can go quite a bit higher, as you can see in this example. Now, again, this example is not just something that I came up with off the top of my head. This happens all the time in the stock market. A stock doubles in price and it doubles again and it doubles again. And at the end of the day, you could have a 300% return, a 500% return, a 10x return. This is actually what happens when you have a good stock. How much higher can it go? Bad question. Now, I remember asking this very question 20 years ago or even 10 years ago. I would take a look at companies and say, wow, that's a big company. How much higher can their stock price go? Well, it turns out that over the past 10, 20 years, they went up much higher. And these weren't obscure companies, right? These were the biggest companies at the time. Now, I heard this quote and it really stuck with me. We as investors might make good buying decisions, right? We buy good stocks, fine, but we have a terrible ability to make sell decisions. We don't sell hoping for losers to recover, and we sell too early when we have winners. This is why this framework is so important to understand when investing, something that I learned too late, but now that you know that, you don't have to make the same mistake. All right, let's talk about risk because many have the wrong idea of what risk actually is in investing. Now, I know I did, and even today I struggle with understanding the concept because it can be confusing to sort of calculate for yourself. Now, for many people, risk is about losing money, right? Can I lose money with this investment? If so, how much can I lose? Can I lose all my money? Well, then it's risky. But I want to expand on this idea. Okay, risk isn't just about losing money. It is also about understanding the return that you get for the risk that you are taking. For example, a US Treasury bond is basically risk free. But because it is risk free, your return is lower. Stocks are riskier, right? In comparison, they can swing 30, 40, 50% in a year. But because of that risk, you should expect a higher return. Now, here's a note on this risk is personal, right? My risk is not your risk. So if you're, for example, constantly checking your account balance and losing sleep over an investment, well, then you might have too much risk on. Whereas somebody else with the same investment might be able to stomach that exact same investment. Now, I always say that to understand your risk tolerance, you need to actually feel the pain. This is the only way that we can understand a risk on that one end of the spectrum. For example, let's talk options for a second. Let's say that you buy a call option with 1 week until expiration. Well, then I can pretty much guarantee you'd be checking your account minute by minute, probably all nervous about that investment, right? And I've done it before too. I would look at it, lock my phone, and then 2 minutes go by and I pick it up again to see where it's at. Now, on the other hand, if you were to, let's just make a small adjustment by buying leaps, right? So buying instead of 1 week out expiration, 2 years out until expiration, well, then I guarantee at that point, you might not check your investment so often, right? This is pretty straightforward. Now, taking a look here at this sort of risk meter, we have a 0 on one end and a 10 on the other end, right? So just on one end of the spectrum of what risk is, taking a very basic look, you can actually put all of these somewhere on this meter. Cash, treasuries, corporate bonds, index funds, blue chip stocks, growth stocks, crypto, options, all of these could be placed somewhere along here. Now, in its very basic form, sure, you can take something like government treasury bonds and put it at 0 risk. Corporate bonds might seem a little bit riskier than treasury bonds, so they might be on this list a little bit further out, right? Index funds, a little bit more risky. Blue chip stocks, you're now talking about individual stock, growth stocks. That could be risky because you could be caught up in some sort of bubble. Crypto, obviously, you can have your own opinions on that, on where you place it. Options, again, the type of option investing that you do, whether you're buying calls, selling calls, that could be placed somewhere on here as well, okay? So I want you to honestly do this, right? Make a line and put these somewhere along here based off of your risk tolerance, okay? So for you, maybe you're just selling options. So options are not super risky for you. Maybe they're down here somewhere. Even taking a look at something like cash. Where do you put cash on here? Now, this is very interesting because cash actually loses value to inflation. right? So as you keep more cash in your savings account, for example, that is a risk, right? That is a risk not only of your cash losing value, but the potential of not making money with that cash. So where do you put cash on here? But risk cuts both ways. Having too much at stake feels risky, but so does having too little. Because if your goal is to build wealth, then not putting enough risk on the table means you'll miss out on returns. Playing it too safe can actually be its own kind of risk. Diversification can reduce risk, but it also can increase a certain type of risk by not making the returns that you desire. So your goal as an investor is to find that balance between what you can stomach in putting your money into a certain investment and the opportunity cost of not having your money invested into another. Now, going back to the chart, I want you to now think of that balance, right? So remember we talked about cash last time. All right, let's say you put cash as a, 1 on the scale. Well, now that you know that you have to balance between not losing money and not making money, you might actually start moving cash to a 3 or 4 or 5, because you're just sitting there with cash and you have all of this potential to invest in while you're not making money. The risk should be calculated within this risk meter. That same thing could be said with something like growth companies, right? Let's say you're investing in good, solid tech companies that are growth companies, but at the same time, wherever this is in your meter, you want to balance that out with the potential of losing money and rather putting your money in something like treasuries, right? Because at the end of the day, depending on how the market goes, treasuries could actually make you more money in certain environments than the growth companies, right? So it's the balance. It's always whatever you're choosing from here in comparison to what can potentially make more money or help you lose less money. Same thing with options, right? Are you selling options? Are you buying options? Are you using it alongside your other investments? Are you buying call options on growth stocks where it might take quite a bit for those growth stocks to actually go up in price? And then you're locked into a certain expiration date. Well, okay, you could potentially make more money, but then you might actually be making more money by just keeping the stock of the growth stocks because your options will lose value if the growth stocks don't go up in that certain period of time, right? I hope this all makes sense. So the first thing that I want you to do is place them on this meter and then adjust them for the possibility of not making money with certain investments, either by not making money because you're just having your money in treasuries, or by losing money on this side on more sort of riskier investments. So as you can see, it's about the relationship between potential loss, potential return, and your own ability to handle the ups and downs. And if your goal is to not just make a bit of money, but rather to make a lot of money and to extract the most amount of gains from your investing, then you need to find this balance sooner rather than later. Now let's talk about one of the most important concepts from the man himself, Warren Buffett. No called strikes. Now, this obviously comes from baseball, right? But when translated into investing, it simply means that you don't have to swing at every pitch. In other words, you don't need to invest in every single opportunity that comes your way. And yet, this is one of the biggest problems that people have, and I've had it too. I used to look around and see people making money in different places, and I felt like I had to jump in. I did not want to miss out, right? FOMO. That fear of missing out can be very dangerous. Now, this framework of no call strikes is very powerful because it really ties back to everything that we've talked about so far. If you are constantly jumping from one thing to the next, you're never consistent long enough to let a strategy work. If you invest in everything, you end up diversifying yourself out of real gains. And if you're swinging at every pitch that more than likely you don't fully understand, you're almost guaranteed to make mistakes, which throws off your whole risk balance out of whack. Now, here's where this gets interesting. Some people will say, but isn't it risky not to be invested, like we spoke about earlier? And yes, you're right. If you sit in cash forever, for example, you will lose to inflation and you'll miss out on compounding. Now, that's a real risk that, again, we talked about and factored into our own risk meter. But no call strikes doesn't mean never investing. It means waiting for that right pitch. Now, Buffett himself doesn't keep money in cash just doing nothing, right? He'll park it in short-term treasuries, for example. At least then it will earn something while he waits. Then when that fat pitch comes in, he's ready to swing with conviction, okay? Now, that's the balance here, right? It's risky to sit out forever, but it's even riskier to swing at things that you don't understand just to feel like you're invested. The opportunity has to be obvious and it has to be within your risk tolerance. If not, then sometimes the best move and the hardest move is just simply to do nothing. Now, I want to take a look at two scenarios here. First, we're always going to start with cash. Okay, so you have cash and you're ready to invest. Well, let's say in this scenario, the no call strikes, you don't know about this concept. So you go into all of these different things without fully understanding them. So the scenario might look like this: you have cash, and then you're like, oh, you watch some video and you're like, oh, these growth stocks are going to 10x, I'm going to be rich. So you put your money in growth stocks that you didn't really research. Maybe you got lucky on a few of them, made some money. But what did you do? Then you cut your losses short. Okay. So you didn't make the full amount of money that you could have had. And oh, wait, crypto's going up. So you take that money, you put it into crypto. Again, this is going back to here, not keeping one investing strategy going for a long enough period. Okay, well, you caught the wrong end of the crypto cycle. You lost a bit of money. You lost the gains from here. And then you go online and you watch some of my videos and you're like, oh, I should just buy call options, which I don't really advocate to unless you do it the right way. But then you lose your money with options. And then at this case, you started out with cash. Maybe you made some, maybe you lost some. At the end of the day, throughout this whole process, you haven't really done anything of value. Okay, you haven't really extracted value through any type of investment. You're just going back and forth and you're not taking this to heart. No call strikes. You want to be invested fully all the time. And you can't time everything perfect, right? Now let's take a look at this scenario. You have cash, right? Same thing as in this. And you can't find anything good right now in the market, right? So guess what? You don't have to do anything. You put your money in treasuries. You make 5% a year. Take that money, you reinvest it, compound a little bit, and then you say, you know what? Instead of trying to pick individual stocks, I'm going to try to compound my money in index funds. So you do what you know. Sometimes that's the best thing. If you don't understand stocks or valuing companies or things like that, trying to pick stocks, then you might as well just go with what you know. And then from here, maybe you learn the strategy of covered calls. And then you have your investing portfolio and you sell covered calls to extract extra value from that. You keep adding to your portfolio. And so even though we both started with cash in these scenarios, we took a look at our risk tolerance, understanding that we don't have to swing at every pitch and you're going to end up in a better scenario, keeping all of these things in mind that we spoke about rather than just trying to go random and trying to make the most amount of money, because you can lose money by doing so. And at this point, maybe even just keeping your money in cash and treasuries could have beat out the returns of trying to do all of this all at once. Okay, so I hope that makes sense. Okay, here is a little bit of a side note, a little halftime reminder of something that I think can steer you in the wrong direction when it comes to investing. Now, I wanted to include this on here because this is, again, something that I had trouble with over many years. And so I'm hoping that you can learn from my mistakes. And that is to not put too much emphasis on the news and understanding that you can be a successful investor by not paying attention to financial news at all. Now, here's the problem. It's tempting to want to keep up with what's going on, right? Thinking that you might find some hidden secret within news reports that will suddenly give you the answers that you were looking for. Now, in reality, this is pretty much never the case. So taking a look at the bigger picture, this is what we have. So no news, right? This is important, right? No matter what you watch, whether it be the financial news or CNBC or even the news in general, you have to understand that they are promoting something. There is always going to be a bias to whatever you watch on the news. In my personal opinion, I don't think that it simply is, here's the information, do what you want with it, all right? That seems to be never the case. Now, investing advice is usually wrong. Jim Cramer is telling you, I would invest in this, I would invest in that. And being somebody, especially I remember watching it in high school, I would look for trying to find that answer. And when somebody says, oh, this stock is really good, I'd be like, aha, I figured it out. And even when they make some sort of investing advice, which is usually wrong, right? There's two sides to everything. So you might take a look at a news report that says this investment is a good idea. Crypto is going up, crypto is going down. These AI tech companies are going to be the next big thing. But then there's always the other side that says, well, I think the market's going to crash, and I think the debt's too high, and I think this is going to happen, and that's going to happen. And now you have conflicting arguments that you cannot reasonably try to decipher. So for me, again, this is something that I had to learn over the long run. Now, sure, it's important to stay up to date with what's going on in general, right? What is the economy looking like? But if you understand that it's all promotion, you have two sides to everything, and the investing advice is usually wrong, you could have a better framework as to why you are watching financial news, for example. Okay. Because you can do very well with not paying attention to that at all and sticking to the basics, choosing good companies, compounding over time, looking at your risk, so on and so forth. All right. So, my personal opinion, no news. I think that can steer you in the wrong direction. All right. Let's take a step back and remind ourselves of something that I mentioned earlier. Most investors can make a decent buy decision, but their sell decision usually sucks. And the truth is that making a good investment is only half of the equation. The other half is knowing if you should sell, when to sell, and how to exit. Now, ideally, if you own a great business that's beating the market, you don't ever want to sell that. Why? Because, well, you don't know how high it can go. Remember, as long as the company is strong, your thesis is intact, there is no real reason to cut it short. Now, the only exception is if you believe there is a clearer and better opportunity elsewhere. And if that is the case, then you need to weigh the risk reward of switching that investment. Now, here's where it gets tricky. In real life, the perfect opportunities don't always line up one after another. So you need to have a framework for how you will handle exits. So first things first, exit an investment only when there is a better opportunity. This should be the number one point to this framework, okay? If there is no better opportunity, then again, you're just playing whack-a-mole with different types of investments and investing strategies, and you're not being smart about anything, right? So let's take a look at these two main ways to exit your investments, all right? So there's time exit and a profit exit. A time-based exit means that you give your investment a set window for the thesis to play out. For example, with options or with leaps, you are forced into a time-based framework because they expire. Now, what is the problem with this? Well, I learned this the hard way with one of my investments. I bought leaps in a company called Roblox, and I gave my investment 2 years to play out. Well, I sold at a loss because my thesis hadn't played out yet. Then, of course, as it happens, the stock jumps over 300% the following year. Now, that is the danger with time-based exits, right? Now, this goes back to the point that I was saying that you never know how high a stock can go, but also you don't know when that stock will move, okay? So time-based exits lock you into a certain period of time, even if it's a mental one. Oh, the stock didn't move this year, let me sell out of it. And that's one of the dangers with time-based exits, right? They keep you disciplined, yeah, but they can also cut you short of that big payoff. Now, a profit-based exit means that you take gains when you've hit a certain target. Like, for example, you have an investment and you sell half when it doubles to lock in profits. You sell another half when it doubles again, for example. Now, obviously, the downside here is that you're capping your returns, right? I sold too early plenty of times only to watch stocks go 5 times higher, right? But looking back, sticking with winners often would have given me far greater returns. So here's how I reconcile this. The goal isn't to box yourself within a rigid rule like always sell 2 years out or always sell after a double of a stock. The goal is to have a plan for your exits so that you are not making emotional and random decisions, all right? So the plan might be I will hold indefinitely unless my thesis breaks, right? Unless my risk reward shifts or I find something clearly better. That is still a plan, and it is one that keeps the door open for your winners to keep compounding. Now, both of these exit strategies can coincide with your goal. So, for example, the time-based exit. Well, the idea here is to ask yourself, all right, I chose a stock, I'm invested in a stock. How long will I give that stock to play out? Am I keeping it for a year, 2 years, my whole lifetime? Understanding the second part of the equation when you buy the stock, when you go into the investment, I think is very important because that will also give you an understanding of when it is time to sell. If that investment is not doing anything in that time frame of which you gave it, well, then you're losing the opportunity cost of investing in possibly a better opportunity. Now, if you don't have a better opportunity, possibly the best thing to do is to do nothing, like we talked about before, but you have to understand that. Now, with profit-based exit, you can think of it like this. I'm investing in a stock. If it doubles, I am going to exit out. Now, that could be a personal choice for you, or you can go ahead and say, I'm not going to exit this position until it 5x's. Now, that might take decades for it to happen, but at least now you have a plan of attack when you go into the investment. That could also keep you from selling too early, right? Like we talked about earlier, and not capturing the full gains. Now, these two concepts don't have to be completely exclusive from one another. You can have a thesis for your investment, something like, well, I'm I'm going to give this 2 years, 5 years, 10 years to play out. But if I make this amount of profit before that time, then I might look to selling that investment only if a better opportunity comes up. So now you can see hopefully how all of these pieces of the puzzles get put together in your overall investing. All right, now I want to talk about options. And this is something that I had to learn the hard way, and it took me a while to finally come to this conclusion. And simply put, sometimes options are not worth it. Now, what do I mean by that? Now, when I started with options, I was very excited for the potential amount of money that one can make when using options and using solely options. As in, I'm only going to do option investing, nothing else, because these people made money with options. I see this online, that online, and I got very excited with the concept of using options to make profit. Now, the more and more I researched and I learned about options, the more I realized that its value comes from not only using options, but rather using options in conjunction with the investing that you already do. But sometimes, even that conjunction, even using it alongside investing, sometimes isn't worth it. Now, let me tell you what I mean. So, let's go through a few examples. For example, selling puts. You might think selling puts could be a nice way to enter stock positions, right? After all, Warren Buffett sold puts on Coca Cola famously to enter Coca Cola stock in order to buy that stock at a lower price. But if our goal as investors is to buy good companies and let that ride for as long as possible to make the most amount of gains possible, well, that difference in price of where you sold a put at and the current stock price at the end of the day might not make a difference. And if you sell puts, then you are missing out on the potential chance to buy that stock, buy that investment. And if it goes up too much and you sold puts, well, then you don't get to buy that stock and you missed out on gains. Should have just bought the stock right there and then. Same thing when selling calls, for example. So you might think, oh, okay, I'm going to sell covered calls on my portfolio to generate extra income. Now, that might be all well and good. But again, if our main goal and my main goal is to take our investments and let it ride for as long as possible, selling calls obviously caps those potential returns. So if I had a stock at 100, sold a call at 105, sure, I'm collecting a little bit of premium, but I am capping my returns. And that means that I cannot be exposed now to the potential 5x, 10x gains that that stock can potentially make over the next 10 years. Not to mention, you're being taxed on your gains, right? You're being taxed on not only the call options that you sold, that premium that you collected, but also on the gains of selling that stock, all right? And that will disrupt the compounding process. And as Charlie Munger said, the worst thing you can do is stop compounding unnecessarily. So for both of these, selling puts and selling calls, you have to be able to go back to your risk assessment and place it on the meter. I have a portfolio of stocks, or I have an index fund portfolio. Do I sell covered calls on that? Where does that lie here? Now, you might be saying, okay, then fine, I won't sell options. All right, you're right that it's not worth it sometimes. But what about buying leaps? Buying options with 2 years out. Now, this is something that I made a lot of money with myself, but also I lost potential in making money with companies just buying the stock outright when I bought leaps. Remember the Roblox example that I gave you? And I will never forget this. I was relatively sure that Roblox would explode in price from where it was trading at because of the technology boom and AI revolution and all that kind of stuff. But the time frame I was wrong in. So even though I bought options with 2 years out, that still didn't give that investment enough time to play out and to fully extract that value from, because Roblox went up 300%, I think 400% over the next few years. And it was just 1 year off of my time restricting leap options contracts. So the final point here is that the greatest investors did not solely use options to make their money. All right. Now, sure, there are a few outliers to this, but at the end of the day, if you take a look at the best investors in the world, nobody's going to be talking about only using options or trading options or selling options for them to have made their money and their fortune. This is why, for me personally, I want to be aware of that and use options only when I think it is right to do so alongside my investments, right? Not all the time, not only, but only when I think it's right and only when I think I can benefit with using options. So options is just a tool. It is not the whole thing. All right. So I do want you to keep that in mind because I know a lot of people here watch my option content, and I don't want you to get the wrong idea from the start that options is the only answer. All right. Okay, now I want to talk about my own personal investing and how I was able to put these pieces together to form some sort of a philosophy for the investments that I make. Now, I started investing back when I was in high school, as in, I had an investing account and I was supposed to add money to that investment account. What did I do? Well, at a certain point when I wanted to go to Europe for the summer, I took out all that money, I stopped the compounding process, and I spent it all in one summer. Now, when I started my business in 2011, I obviously looked back and regretted that decision, right? Because I looked at the compounding process and I said, well, I could have used a little bit of the income that I had, invested it, and by this time I would have had enough money to start my company or at least be better in a better position. Nonetheless, I started fresh, and as my company was generating money, I was able to invest more and more money. And I was doing it randomly at this point, right? I didn't have an investment strategy. I didn't understand what growth investing was, what I could have put my money in dividends, collected dividends. I didn't understand practically anything. Now, the more I learned about these different investing strategies, the more I started fitting into a particular one. I also understood that I could start compounding my money more with a greater rate of return if I add to the compound machine and add to my passive income investing. So I took money from my business, and anytime that I would make a certain amount of money, I would take an X percentage and I would put it into that compound machine. Now, suffice to say that I had once again broken that compounding process back in 2014-15 on personal matters and needing money for the business. A lot of things came into play where I had to liquidate my investment portfolio to fund my business. Now, sometimes that might be the right answer, and in my case, it was for the time. I started my business back up and it grew exponentially at that point. I started making better decisions, not only in business, but investing and using my money to make more money. I wasn't making the same bad decisions with my money that I was previously. Like, for example, I spent $200,000 on cars that I did not need in the first year of my business. Really bad decision when I could have taken that money, putting it to work, and letting bad compound even without knowing anything about investing. All right. So I took out all the bad decisions and I started making what I think to be better decisions. And I learned about investing over this time. I read books, I watched videos, I learned about options. I learned about my own risk tolerance and learned where my money should be going and where it shouldn't be going. Slowly, I started building a portfolio of 10 stocks. Now, I know I didn't want to pick more than that only because I didn't know enough about all the companies, right, to make a good decision on more than 10. But I figured 10 was a good amount to start with. And it was no more than just a decision of keeping it simple. Okay. 10 stocks sounds good to me. Now, what I learned very quickly is that you want to let your winners ride and cut your losers short. All right. So, like we talked about in this video, you want, if the stock is going up, one stock out of your 10, if it's going up, you want to keep that going. All right. At one point, out of my 10 stocks, Shopify made up about more than 50% of my portfolio, right? And I looked at that and I said, "Oh, wow, this is risky." Again, not understanding these full frameworks and concepts, and I sold out of Shopify and I put it into the other companies that were not doing so well. Big mistake, all right? Because why? Shopify went up to do a 10x at that point, or 5, 10x, something like this, where I could have obviously made a great return. But because I watered cut the flowers, watered the weeds, I had to learn that lesson the hard way. And again, I asked myself, how much higher can it go? Again, this framework would have been really good in that scenario. You want, if that stock is going good, well, put more money in it, take it out from the losers and put money into the winners. Now, this lesson taught me that letting your winners ride will eventually result in a concentrated portfolio. And this made me fall in love with the idea of taking away the diversification and going more concentrated in on the winners. People like Warren Buffett, right? Monish Pabrai, Nick Sleep, you can do some research on those last two, especially, have understood this concept of concentration and how those lead to great returns. And through this process, I realized more and more that I don't have to jump into every investment that comes my way, right? No cold strikes. Now, come 2020, I was sufficiently knowledgeable, I would say, with options to have confidence to make asymmetric bets. So I'm betting one to potentially make 5 or 10. I took some of those gains and I invested it in crypto, again, an asymmetric bet. If I lose that amount of money, I'm okay with, but the potential gain could be pretty big. So here are some very important questions that I asked myself to create this philosophy. Can I double my money in less than 7 years? This is the first basic question that I want you to ask yourself. All right. Can my income then help beat the market? All right. So, do you have an income that you can start adding and adding consistently to your investing that will help you generate more than a 10% return? So, these two questions are very important to understand your philosophy as an investor. For me, can I double my money in less than 7 years? Well, I personally think that at least I should try. All right. And I think that there are ways to beat the market. And I think it's not easy, but it's not impossible at the same time. So I know that I could have used my income to beat the market, and that will actually double my money in less than 7 years. So that alone I knew was possible. I knew I can add from my business. I took a look at what that potential return is, and I asked myself, can I do better? And again, I think the answer is yes. So again, for my personal investing, I want concentration over diversification, right? I want to add to my winners and I want to take asymmetric bets when possible. So this last framework right here is very important, all right? Concentration over diversification, add to winners, cutting losers, and asymmetric bets. Now, if you want to go deeper into this strategy as a whole, concentration, adding to the winners, and taking asymmetric bets, a way of beating the market, well, I did a whole other video on that, and that should be the next one that you should watch. I've taken research from the people that have beaten the market, and I've tried to put that all into a strategy that you can use to make more money. So I hope you can take these pieces, put them together yourself, and create your own philosophy of investing. I hope you enjoyed it, and I hope you learned something from it. Thank you for watching, and we will see you on the next video.